All right, guys, I think we are live. Let me know in the chat whether you can see and hear me. All right. Now we're cooking. Well, we have gold and silver hitting those price points that many people thought they would never hit. We'll see they're fairly psychological levels, so we'll see what kind of staying power they have here. Maybe they blow right through them, no problem. Let's go ahead and pull up the charts here. So silver right now is at 101, almost 102. I mean, when you look at this chart, it is just crazy. This literally looks like a like something you'd see on a penny stock or something. It's just crazy that this massive straight line up there, just vertical. And gold looks fairly similar as well. Gold's at 49.77 right now. It did touch 5,000, I believe. Maybe in some markets. Now, some of the consequences of at least gold hitting these levels that most people are not aware of. The trade deficit shrinking over the last couple of months, like 70% of that is due to the price of gold going up. It's from non-monetary metal, not monetary metal. This is not like hoarding gold for just central bank purposes or store value. Non-monetary gold purchases, imports and exports differences. That accounts for 70% of the decrease in the trade deficit, which I think is very, very interesting. Let's see, what kind of questions have you guys thrown in there so far? What are your favorite indicators that correlate to the re-accelerating economy theory? Well, kind of depends on what you mean by the re-accelerating economy theory. There are a couple of things to keep in mind. Number one, the last couple of years, we have seen what I'm calling non-technical recessions. So I covered this in my most recent YouTube video, but in 2022 we had a decline in GDP, and then 2025 we had a decline in GDP. Both of these correspond with a with the yield curve indicators. Typically, when the yield curve goes inverted, you have a recession that follows, and then typically when the yield curve uninverts, you have a recession that follows. Depending on the time frame that you're looking at, whether you're looking at like prior to the 1980s or after the 1980s, the recession will kind of either be closer to the yield curve inverting, or the recession will be closer to the yield curve uninverting afterwards. But we did have a decline in GDP during both of those times, which it wasn't 2 consecutive quarters of a decline in GDP, but it was still the economy shrinking. And that's ultimately, at the end of the day, when you talk about the technical definition of a recession, that's just made up, right? Like the reason why we call it a 20% downturn in the stock market a bear market is just because that's what people have decided to call it. So the parameters or the measurements or the fences that we put up around these definitions are at the end of the day just made up. When you give it a little bit, like look at it a little bit more loosely, you realize, okay, well, the economy did shrink for a quarter in 2022. It shrank for a quarter in 2025. The stock market had a 20% downturn in both of those times. And so the idea that we haven't had a bear market, haven't had a stock market crash, haven't had a recession in like, over a decade is just not true. Um, and so, we overall, economically and market wise, we're not in a position where it's like everything is due for a pullback. There, economically speaking, and in the market, there have been pullbacks, plenty of them. The other thing is when you look at monetary policy and fiscal policy, everything points to everything continuing to be run extremely hot. Interest rates are getting pushed down at the short end. That encourages or supports government spending. That's new money coming into existence. When you look at bank deregulation to buy the long end of the curve, the treasuries, that's coming down the road. Everything that we see is supportive of prices, cost of living, and assets moving higher. So I think all these things together mean that the chances that we are right now set up for like a lost decade or a huge long lasting recession or anything of the sort, I think it's probably more likely that that things continue moving up, not sideways or down overall, with increased volatility along the way. All right. From EJB93747, can we really consider the U.S. Treasuries as risk-free moving forward, particularly as the Bank of Japan has to sell off treasuries to prop up the yen? Well, it depends on what you mean by risk-free, because that term is assigned, but it doesn't. There's no such thing as risk-free in reality. When you talk about risk, you're wondering, okay, what are the chances of me losing some money or the chances of me losing everything? With treasuries, the odds of the government just defaulting are very, very, very slim. It can't be impossible, but it's very slim. In the case of the U.S. government defaulting on treasuries, what they would have to do is basically hit a debt ceiling with political gridlock, with nobody willing to give in and running over the time limit, getting to the point where there's no money left in the Treasury General account and they can't make payments on interest payments on the outstanding Treasury debt. Every time it's gotten to that point, they always come to some sort of agreement, whether it's even if it's just delaying it and just approving temporary spending. So it's not impossible for defaults on treasuries to happen, but it is very, very unlikely. Now, even in that case, what's likely to happen is that the payments are just missed and then they're made up later. An outright default where you just don't get paid back is as close to zero as really anything is. The only thing that would be like closer to zero would be if you were able to get your money parked straight at the Fed like the banks do. So because there's no political gridlock there, they just decide to create the money to credit the interest on those accounts. That's the only thing that would be lower risk of default than treasuries. But when you talk about losing some of your money, then you have to take into account purchasing power. And what are the odds that you are getting a real positive yield on your treasuries or on anything that is indirectly in treasuries? So that's money market funds, high yield savings accounts, checking accounts, things like that. The odds are very high. In fact, when you look at real yields of like the 10-year treasury going back, 100 years, the vast majority of the time, the real yield is negative. For most of history, the U.S. government is able to borrow at a rate that is lower than the rate of inflation. And so it's very low risk in terms of you losing everything, but it's very high risk in terms of you losing some if you're measuring with real purchasing power. So, and that's really the spectrum. The more guaranteed something is, the lower the real income you're getting from it. The less guaranteed something is, or the more risk that you see, it should be paired with a higher potential return. All right. Guys, remember to tag me if you have a question for me, and like obviously use the chat for however you want. You guys can talk with each other and stuff. Place comments, but if you have a question directed at me, make sure you tag me in it. That way I see it, because it highlights, it shows up orange when you tag me in it, so I can see it. Question from Matt Nader. You mentioned you were putting on a short-term short on silver recently. What do you define as a short-term? I mean, it's super subjective. It depends. For me, that's usually, I usually don't do anything like on a day-to-day basis. I'm not day trading. So shortest, a couple of weeks, for a short-term trade. So it was a very, very small position on, with those puts on SLV, which obviously I'm glad about. And I'm making more from the silver that I'm holding from the losses on that, on those puts. So, all right, let's see. Does the recent silver price look parabolic to you? If you had silver or silver miners, would you take profits here? Well, the way that I'm currently playing it, which this could change at any moment, but the way that I'm currently playing it is, I'm holding my long-term silver holdings, not making any changes there, and then probably every month or so, I'll maybe more frequent than that, I'm going to be looking at playing for short-term pullbacks by looking at puts on SLV, something like that. It does seem like the price action is, just like technically speaking, overextended. But markets that start doing this, when markets, even if they are actually overextended, even if it is actually overbought, that can continue a lot farther and a lot longer than a typical market participant would expect it could. And so I'm not trying to, in times like this, it's very difficult to time bottoms and tops. And so this is why, like the old adage, like the trend is your friend, comes in handy, because you keep on going with the trend until the trend is broken. Which means you're not going to nail the tops and the bottoms, because by the time the trend is broken, you're not at the top anymore. But it can help you ride the wave a lot longer than you might if you were trying to time it perfectly and get the exact top, which is almost impossible outside of getting lucky every once in a while. All right, next question here. All right, I'm seeing a bunch of comments. Sorry for the delay. That it's too quiet. Let me see what I can do to boost the volume here. All right, I think that should boost the volume. Let me know if you think that I need to continue to increase the volume there. I don't want it to start clipping or it to sound like it's messing up the audio by getting too loud. But if you can't hear it, then that's also bad. All right. Do you think go down next week with big tech earnings? Market doesn't seem to like anything much right now. I assume you're talking about the market overall. It seems to me like the market overall. Let's pull up the chart here. All right. So if you look at the chart of just the S&P 500, there's a couple of things. Number one, we've had some really good consolidation over the last couple of months. Got a nice little wedge forming here, and we could see a breakdown or a breakout to the upside from that. This is overall trending a little bit higher, which might lean you to be a little bit more bullish. But when you have a lot of volatility like this, with price consolidation, with the volatility decreasing along the way, it's basically like a spring coiling, where you have both the buyers and the sellers, the bulls and the bears, are kind of winning. They're pushing the price extremes closer and closer together. And at some point, one of the sides becomes exhausted, and usually that's due to something fundamental. So if earnings seasons come out just even a little bit unexpectedly strong, then I would anticipate a very strong breakout to the upside here. Keep in mind, we did have a 20% drawdown, a bear market just a year ago. And so to have something, another 20%, another bear market right here would be fairly unprecedented. I mean, we had 3 in the course of just 5 years. That alone is unprecedented. Usually it's like 1 every 5 years, if that. And so the fact that we have had so many bear markets recently means that we should probably expect just more volatility in the future. But also it means that the bearish price action recently has taken place. It's not like we're sitting on, every single participant in the market just now being bulls. We have flush outs that have gotten us here. That's healthy if you are bullish long term. You want to see drawdowns, you want to see price consolidation, you want to see some volatility. You don't want to see a straight line up, because those can be easily followed by straight lines down. And so I wouldn't be surprised at all. We get a couple of earnings releases that are just a tad bit better than expected, and this thing starts flying up. All right, next question. For someone buying their first home with significant precious metals holdings, is it typically smarter to liquidate some of the metals or borrow against them instead? Well, it depends. So if you are borrowing equals risk. And so if you are borrowing against your metal to get a down payment, and then also borrowing for a mortgage to buy the house, you have now 2 levels of debt there. That's fairly risky. As somebody who is risk averse, I like to manage risk as much as I can in pretty much every area of life, especially financially speaking. I don't like expensive debt. Now, you can get cheaper debt when you've got collateral, but after a huge price increase, there's the chance that a significant pullback happens, which means that you might get liquidated. You might have a margin call on your metal. Now, if you're saying that you're going to be able to borrow everything you need to buy the house by borrowing just against your metal, and the interest rate is better than a 30-year fixed rate mortgage, then that's something to think about. The problem is usually the interest rate on a collateralized loan with like gold as the collateral. Usually they're variable, which means that the interest rate could change on you. So while it might be better right now, may not be better in the future. So one of the advantages to a regular mortgage is that it's locked in. And so if inflation starts ticking up higher over the next 5 years, 10 years, 15 years, then you're going to be able to keep that dollar short. That's what a mortgage is. It's a short against the dollar. You're going to be able to keep that locked in. So there's always a trade-off. You have to look at both sides of the equation and see, okay, what risks am I taking on? What risks am I giving up? Or am I protecting myself against? And then the last thing to consider is your overall portfolio allocation. So if you have 100% of your net worth in metal, you're pretty concentrated, and there's always additional risk when you have everything in one basket. So diversifying by reducing, the percentage of your portfolio that's in metal and allocating some of it to real estate, it can help decrease overall risk. But again, concentration works both ways. So concentration will work against you if it's going down, but it'll work for you if it's going up. And so if you do sell your metal to buy a house and gold goes from 5,000 to 7,500, you'll probably be kicking yourself. So I don't know your exact situation. You have to kind of weigh some of this on your own, but those are the considerations that I'd be looking at. All right, guys, remember to tag me if you have a question for me. That way I see it. There's one in here from JW Rancher. Do you like SLV better than Sprott physical silver? No, not necessarily, but if I'm holding on to something for it depends on the reason why I'm holding it, basically. So if I'm buying something just purely for the exposure to the price, then I want the best price possible for that. So I want the lowest expense ratio. I want the best bid-ask spread. If I'm doing options, and I want, volume on those options, tight bid-ask spread. I want all the expiration dates and all the strike prices available. And then because some of the, I don't know specifically about Sprotts, but some of the other ETFs that are a little bit more designed to appeal to the physical stacker, they have very little volume, wide bid-ask spreads, higher expense ratios, very illiquid options if they exist at all. So it depends on the reason why. If it's just a price thing, then you're not, there's nothing wrong with, doing something like SLV. However, on the other hand, if you're doing it because you're like, hey, well, I want purchasing power in case of, an apocalypse, then, the physical ETFs aren't going to serve you. So you'd go all the way to the extreme of holding it physically, 1 ounce coins type of thing, in a safe at home or buried in the backyard or something like that. So the physical silver will give you protection against things that no ETFs will. Now, the problem with that is the cost of that, because you're going to pay not just spot, you're going to pay for delivery, you're going to pay for the premium for the person who is selling it, that had to store it physically and had to insure it and had to keep it along the way. So there's always a trade-off. Now there's maybe a middle ground that you want to protect against, because you don't want to hold it physically. You want the cheaper access to silver, but you want the higher certainty that the silver is actually there. So maybe the Sprott ones or others look a little bit more attractive to you. Just know that in a worst case scenario, those are not going to do the same thing as actual physical will for you. Okay. Next question. When I go to the farmer's market and I use my silver, is this a capital gains event from which I would need to report taxes? Yes. Yes. Now the thing is, you would need to report it. It would be difficult, not impossible, but it would be difficult for that to be discovered. But yes, if you are getting rid of it in exchange for something, that is a reportable taxable event. Not in some states, but federally, yes. Okay, question from Aaron. Are there any potential squeeze and IPO opportunities on your radar? I had a few high ROI squeezes and large IPOs in 2020 and 2021 that were sold low initially to sell higher. In general, I personally don't like investing in IPOs. The reason why is IPOs most of the time tend to be liquidity events for early investors. Often the company is IPOing in order to raise money so that they can invest in larger future growth. They need an influx of cash that they can't get from private investors. That being said, oftentimes they end up also being liquidity events, exit opportunities for early investors. Early investors who either were there when the company started and they have a large percentage of the company, or early investors who purchased at a much, much, much smaller valuation. And so because of that, what you tend to see with an IPO is for the first 6 months or year or even longer, the stock price will plummet. There'll be usually an initial pop. But after that, what tends to happen is the stock price will decline very rapidly. We can look at a couple of examples. So these are from, the 2020, 2021 IPOs. So you see Coinbase IPO'd back here at, $300 per share, something like that. Initially spiked up to 400. And then within the course of the next, was that the next year? Because this was April 21. So yeah, about a year later, it had almost bottomed here. It had almost fallen by, 90%, 80, 85% there. And then it even got down to 30%. So from its high after the IPO to its absolute low, that was a decline of 92%. And so what ends up, the reason why is because during these there's a lot of early employees. There's a lot of initial investors during the lockup period or after the IPO. They'll just start selling because there's finally the ability to do so, to cash out and get rewarded for all of those years of hard work, and they're cashing out. Now, a lot of times you end up seeing this kind of thing too, where after it bottoms, it'll eventually start going back up. And that's because the company usually does IPO to raise money so that they can do some good things for growth. They're investing in the company, they're hiring new people, they're building new infrastructure, whatever it is. And eventually that results in future earnings growth. But oftentimes you see a pattern like this. Another one is Robinhood. Did the exact same thing. IPO, big hype, and then a big crash. And then only recently has it started doing better. Another one, I think Carvana did the same thing. Okay, they IPO'd a lot earlier than that. They IPO'd in 2017. I did not realize it was that early. Let's see, what are some other recent IPOs? I think Lemonade was another example. Yeah, Lemonade was an example. It initially IPO'd and then, it exploded on the hype and then, fell down and bottomed. This is one that we went long in my private trading group right around October of last year with options. So that one's been doing very well. So anyway, we see a lot of examples of companies that IPO. They have some initial hype, they pop, suck in a lot of retail investors, and then it ends up being a liquidity event for early investors, and the stock plummets because it doesn't meet those initial hype levels of earnings or revenue growth. So personally, I tend to avoid investing in IPOs usually until it looks like the bottom is in. Now, that's not every time. It doesn't happen every time. It's not a universal thing. So there might be exceptions here or there. Like one company that I invested in immediately. This was also one that my private trading group was involved in. Immediately was Oklo. At the time, there was very, very difficult to get any sort of investment in the public space in small modular reactors. And so that was one that initially, like as soon as it IPO'd, I think it IPO'd through a SPAC, but still, as soon as it came out, we got in on. That one has done very well. But for the most part, I don't like IPOs. Squeezes, there are the problem with a squeeze is you need two things to happen. One, you need a really high short interest, and two, you need that short interest to be misplaced. You need like really solid fundamentals. And the problem is the vast majority of time, there's a good reason why the short interest is so high. It's because the fundamentals are collapsing and the company sucks and it's probably going to go to zero. And that's why everybody is shorting it. And so it's really hard to find, not just to find, it rarely happens when you see a really high short interest plus solid, really, really solid fundamentals. It can happen, but it is fairly uncommon. Let's see. What is your view on the 10-year? This is from Verinder. What is your view on the 10-year upward SPY channel? Every time it hit correct significantly. What is your view on the 10-year upward SPY channel? I mean, if we take a look at, let's see, you said 10 years, so that goes back to 2016. Yeah, right around there. I mean, I'm not sure exactly what you mean by like what channel are you seeing that every time it hits it drops? Because if you draw a trend line from here in 2016 to like here, then that, we blew through that. But if you're drawing it based on touching right here, we blew through that. If you're drawing it based on touching there, we just recently crossed above there. If you're drawing it where we're at right now, we never touched it before. So I don't know exactly. Maybe you're looking at a logarithmic chart. Going back to 2016. No, again, there's not really, I'm not really sure what channel you're looking at there. And that's kind of the thing about some of the long term. I've seen a lot of these charts that are like, oh, going back 100 years, we're in this channel. But then you look closer and you're like, well, the number of false breakthroughs or breakouts or breakdowns is fairly high. The number of actual times that it touched is fairly low. They had to cherry pick the starting and ending point to get a line that kind of matches up somewhat. And still, if you were to go back a little bit further or start your time frame a little bit later, you wouldn't have a channel like that. And so looking at like trend lines over really long periods of time are usually unhelpful unless you're investing over that exact same time frame. And nobody's investing for a 100-year time frame. So markets are fractal with like technical analysis. You look at charts, if you didn't have dates or times on them, you wouldn't know the time frame associated with it. They look identical. And so they are useful for the time frame that you're looking at investing in. So if you're going to be day trading, yeah, look at a minute chart. But if you're investing for years, you don't need to look at a 1 minute chart. And vice versa as well. If you're investing for years and years, then look at a very long-term chart. Don't be looking at, what's happening on a day-to-day basis. So, all right. What's your thought on DVN? I don't know what DVN is. Devon Energy. I don't have any thoughts on that one. I don't know. It looks like Morgan Stanley just reduced its price target on it. Recently, it's had some good upward price action, but longer term over the last couple of years, hasn't been doing as well. And so, yeah, I don't have any opinion on that. Not really too familiar with that company. Looks like their earnings over the last year or so have been mixed. Overall, energy-wise, I like energy, but you have to pick. If you're not doing like an index, then you have to pick them well. All right, from Matinator, what are your thoughts on GDP? George Gammon pointed out the K-shaped economy going forward, economy outcome going forward from the consumer struggling, but the large cap company growth overshadowing in GDP. Well, I have a couple of thoughts. So in general, I think it's evident that the further ahead you get, the easier it is to continue to get further ahead. That's partly from skill, because once I've developed the skills to make $100 grand a year, I'm never going to make $50 grand a year again. Once I've developed the skills to make 500 grand a year, I'm never going to make 100 grand a year again. Once I've developed the skills to make $3 million a year, I'm never going to make $1 million a year again. Once I've gotten to the point where my skills plus my discipline has gotten me from 100 grand to $1 million net worth, unless I make really big mistakes, I'm not going back down to $100,000 net worth. Different investing opportunities are opened up to you just because of the legal restrictions placed on poor people. Your skill level and your discipline allows you to see and your experience allows you to see opportunities where before you might have only seen problems or you just might have missed them. And so all these factors together mean that, and also you're able to last through hard times easier without it being devastating for you. And so all these factors together mean that the more money you make and the more money you keep, the easier it is to continue to get further and further ahead. Then when you add in the economics of our time with monetary and fiscal policy where they're at, that make it more and more difficult to have your income increases match inflation increases, and your savings continue to decrease in purchasing power, it makes it harder to get over that tipping point. So those are all true. Some of the things though are not able to be represented in the data. Like a lot of young people today. A lot of young people today are like they might be the Gen Z plus younger millennials might be the most entrepreneurial generation that the United States has ever seen. And a lot of that is not accounted for in the employment data and things like that. And in an age where we have computers that make everyday tasks easier and easier and easier, it means that the temptation to just consume is higher than it's ever been. So for the people who decide to be the ones that are going to produce, it's really never been simpler to get ahead. Now you have to ignore those temptations and you have to resist those temptations and ignore the distractions. And you have to consume a lot less than you produce. And again, that's difficult when you're starting out. But the number of people who are doing that are decreasing. And so it allows you to, means that the level of competition is probably not where it used to be. And the amount of free information and help out there to get started with doing that is better than it's ever been, which means that if you want to double your income or triple your income, if you want to learn how to successfully consume less than you produce, if you want to learn how to just invest the baseline just to make the market averages, you can learn how to do all of that for free. The information and the training and the teaching is out there. It's just a matter of doing it. But that also means most people are not going to do it. So, all right. From Mook Davis, when would it be wise to open a Roth IRA under a business LLC? Is it mainly for real estate or can it be any LLC? Not really sure exactly what you're asking about there. It sounds like you're asking a question about like something very detailed and specific that you're trying to do. Or that you thought maybe I've talked about before, and I'm not really sure exactly what you're referring to there. In general, real estate should almost probably never be placed under an LLC because, not an LLC, in an IRA, because one of the main benefits you get with real estate is the tax advantages. But putting it in an IRA means you're eliminating those tax advantages because it shields everything, anything that happens tax-wise is shielded inside of an IRA. So, yeah, I don't know what you mean by would it be wise to open a Roth IRA under a business for real estate? Just in general, the earlier, you don't have to, I don't know. I also don't know what you mean by open a Roth IRA under a business LLC. Roth IRA means individual retirement account. It's attached to your social security number. It's not attached to a business. You can go open up a Roth IRA anywhere you want immediately, right now, as long as you're 18. If you're under that, your parents can open it up for you, and you can put money in as long as you have earned income. And so there's no time limit. Like, the earlier you get started putting money in a Roth IRA, the longer it can grow for you tax-free. And you can withdraw it once you retire tax-free. All right, from Unknown YT. Thoughts on upcoming Amazon earnings? I'm bullish due to recent layoffs. Amazon is one of those companies that will probably reach the singularity, the robotic singularity, sooner than anybody else. They have continued for years now. Their personnel, their headcount, the number of people they employ has continued to go down and down and down and down and down and down. Meanwhile, their robotics that are taking over all those jobs that people used to do continue to go up and up and up and up and up. I don't know exactly how far they are away from that number switching, but I don't think they're too far. And so Amazon is, just full disclosure, one of those companies I am long and I've been bullish on for a very long time, given their valuation and given what I know about their culture and their long-term view on success and the culture of employees that they have and how hard they work on getting things done, and the ultimate goal to be the place where anybody can get anything they want for as absolutely as cheap as possible, like being the low cost, high quality leader of everything for the entire world. And they've continually proven to be able to do that along the way. And so I think the short-term struggles that they're having right now, at least the stock price and maybe some leadership issues, I'm not really sure how much people really like Andy Jassy. But overall, like, it's a company that I'm very bullish on, but I am long, so I take that for what it's worth. And I don't have a short-term prediction on price, so it could go down for sure. Don't call it 5K gold till it happens. I saw somewhere it did actually hit 5K, so I wasn't predicting it. Maybe it wasn't CFDs, but it was somewhere I saw the quote hit 5K. Maybe I'm wrong about that. I thought I saw it though. All right. I have a traditional IRA with Fidelity. Are mutual funds best for this? That's like asking, hey, I have a Toyota Corolla. Where should I buy gas to put in my Toyota Corolla? It's like, mutual funds are just a wrapper for stocks. So there's no fundamental difference between you picking out 100 stocks yourself, buying a mutual fund with those same 100 stocks, or buying an ETF with those same stocks. There's no, like, mutual funds as a category are not good or bad or best or worst for anything. So then from there you have to look at, okay, well, what is a mutual fund? Okay, it's just a bucket of stocks. So what are the stocks that are in the mutual fund? That's going to determine whether it's going to be good or bad. What are the fees with the mutual fund? A lot of old mutual funds especially have extremely high fees. And they've got hidden fees. They've got expense ratios. They've got loads. They've got front end fees. They've got back end fees for when you buy or when you sell. And so mutual funds, just being old investment vehicles, can sometimes be very inefficient from a cost perspective that can decrease your returns over time. But there are plenty of mutual funds that are the opposite, that are even more cost effective than ETFs. Like if you go and you get the actual Fidelity mutual funds, or you go to Schwab and you get their mutual funds, or you go to Vanguard and they get their mutual funds, a lot of times they can be almost free. So it depends on the mutual fund you're looking at, and it depends on what the investments are inside the mutual fund. With an IRA, it's just a tax wrapper. And so it's a bucket that says, okay, anything you put in here from a tax perspective is going to be taxed differently. So for a traditional IRA, you get a deduction when you put the money in, and then you pay income tax when the money comes out. You can invest in anything inside of an IRA. You can do options, you can do stocks, you can do cash, you can do money market fund, you can do mutual funds, you can do ETFs. And so based on the question, here's what I would recommend for you. Spend 40 hours watching every YouTube video you can find about basic personal money management and intro to investing. 40 hours sounds like a lot, and it is. But if you do that, you will be more knowledgeable on this topic than anybody, and it will expose all the things that you don't know. Like that question, just it's a big red flag that means like you don't know, you don't even know what you're asking. And so I would recommend 40 hours of YouTube videos on introduction to investing. What is a stock market? What is a mutual fund? What's an ETF? What's a stock? What's an IRA? How do these things work? Intro to investing type of material, and you'll have your answer once you go through that education. All right. Question from David Hackney. Looking at CRDO to add to my AI quantum portfolio. Do you have any thoughts on it over the next 3 years? I don't know what CRDO is. CRDO, Credo Technology. What is this thing? It's going to pull up for me. Engaged in development of connectivity solutions and products for the data infrastructure market. Its products include integrated circuits, active electrical cables, SerDes chiplets. SerDes? The company was founded by Chi Feng Cheng and Yat Tung Lam in 2008. On 2008. That's weird. I should say in 2008. It's headquartered in Georgetown, Cayman Islands. What is the market cap of this thing? 24 billion. 121 price to earnings ratio. Oh my gosh. Okay, so the market right now is pricing in insane growth for this thing. Like insane growth. Just to put that in perspective, what is a price to earnings ratio? That is what is the price of the stock compared to how much profit the company makes per share. And so hypothetically, if nothing changes on their earnings, their profits, and nothing changed with their stock price, and they decided all of our profits we're going to just pay out as a dividend to shareholders, it would take you 120 years just to get back $133 per share. So the reason why it's so extreme is because the market is saying, okay, well, we think that the earnings are eventually going to catch up, and that buying it here at this valuation is justified based on those future earnings. It's like you're paying $130 for a money printer that you think maybe in 10 years or something will be printing out a lot of money, but right now it's printing out basically zero. So it's an extremely speculative bet based on just the price to earnings ratio alone. It doesn't mean it's going to be wrong. But it means that the market is pricing in already massive future growth. All right. From Beyond the LOL. What are the best financial instruments to invest in copper and such? I mean, there's no such thing as the best financial instrument. Use what you know. Like if you're comfortable with and familiar with ETFs or stocks or with options or with futures, that's fine. You're not going to have it's like there's let's say there's a computer programmer making 120 grand a year, and their neighbor is a plumber, and their neighbor as a plumber is making 200 grand a year. And the programmer is like, oh man, like plumbing is a better way to make money. I should go do plumbing. It's like, no. There's programmers that do way more than $200,000 a year, and there's plumbers that do way more than $200,000 a year. It's about doing the thing that you can make the most money at, not that people in general or some other person could make the most money at. Your skill set might not align with that. And so, or maybe your skill set could, but maybe your time doesn't allow for that. Maybe you can't watch the markets throughout the day, and your ability to place trades is very limited. And so there's no such thing as a best financial instrument, but there is a best financial instrument for you. It's just, what do you know and what are you comfortable with? And now do the best with what you have. Play the hand you're dealt. because if you try and play somebody else's hand just because somebody else is making more money, you might not be equipped for that. The programmer tries to go be a plumber. Now they're making 50 grand a year instead of the 120 grand because they don't have the skill set of their neighbor. So you can invest in stocks, you can do options, ETFs, copper miners, futures, whatever. What do you know? All right. Do you have certain companies or ETFs? Oh, where to go? Offering dividends you intend to hold indefinitely? Well, no, there are stocks or funds that I would ideally hold indefinitely. Like I've got a free Century portfolio that it's a model portfolio of 10 to 12 stocks that that I would hopefully or ideally be able to hold forever. But stuff can change. Like this is like Warren Buffett says the same thing. I would want to buy these stocks and hold them forever. But guess what? Sometimes he sells stocks, right? Like sometimes, like he's recently been unloading his bank stocks. He sold half of his stake in Apple. Like when the valuation changes or the fundamentals change or the management changes or the macroeconomic landscape changes or something happens, it's like, well, now this is time for me to get out. There might be a better opportunity. So there are definitely stocks that that I have an opinion on that I think could be, Century stocks, things like Berkshire Hathaway or Cummins or Amazon or Costco or Monster or Toyota or Exxon or Caterpillar or Chubb or McDonald's or Waste Management or Yeti. But any of those could potentially, change overnight, and the reason for investing in it, could change. All right. Thoughts on Rick Ryder for Fed chair. He's now top odds on Pauli and Kalshi. His views seem to align with the reality of a higher inflation, populist, K-shaped economy regime. I think no matter who it ends up being, we're going to see increased QE, maybe soft yield curve control. We're going to see bank deregulation to allow them to buy more treasuries at the long end. We're going to see probably lower short-term interest rates, all to enable the government to continue inflating away its debt. We're in a time period that will look very similar to the 1940s to the 1980s. Higher prices, higher long-term interest rates for all of us. The government continues to be able to borrow and spend at a rate lower than the rate of inflation. And so it offloads the pain of its debt to the economy through that inflation. And I think that it's inevitable based on the current economic landscape. Because even if the Fed, whoever's in power, tries to resist that, the longer you resist it, the more you build up kind of a rubber band that snaps back with a deflationary force that will force them into making those changes. Similar to like 2019, end of 2019, when liquidity out of the system got completely sucked dry. So the Fed had to step in with not QE. Same thing is happening right now. All right. Do you have any thoughts on Webull? I didn't know they were. Did I know they were publicly traded? Webull. Bull. Oh, geez. This is another example of one I was talking about where it's like IPO, initial pop, and then, I guess they're trading at a price that's very similar to the IPO price now. They're only down 30%. But if you measure them from like the pop of the IPO where a lot of people were buying in here, they're down 90% from there. That's crazy. Again, there's a reason why these companies do this. There's insiders exiting, early investors exiting. There's the lack of expectations coming true in reality. Man, that's crazy. Let's see. $4 billion market cap. Yeah, I don't know. I'm not a huge fan of the product. I don't see anything really wrong with it. I don't know much about the leadership, or like I know like companies like Robinhood, like they've got a little bit more of like a cult following. But especially when you compare it with like competitors, like Interactive Brokers, obviously, like I guess when I say competitor, I just mean other companies who are offering similar or better products, bigger companies. Interactive Brokers has obviously been doing very well, so there's not like also like SCHW is Charles Schwab. They've been doing very well. Robinhood, until recently, has been doing very well. Let's see. Is Moomoo publicly traded? No. Who else? Is TradeStation? No. What about no, Vanguard's private, so is Fidelity. Let's see here. Who else is publicly traded in this space? I mean, you could put Chase in there because you could put him in there. So anyway, it's not like the entire industry is going through like a really, really hard time right now. They're doing poorly despite the fact that all their peers, competitors, larger companies are doing much better. So I don't know. Top 0.02% viewer this year from Uncalculated Bets. Wow, that's crazy. Thank you. I appreciate that. You watched basically all my stuff then. I appreciate all you do. I appreciate you watching. I do it because you guys watch. I do it because you guys join and ask questions and follow along. And so glad that it's been helpful. Curious what charities you give to most often and what cause you're most passionate about. That's a good question. The charities that I give to consistently, like just on autopilot, just on like, auto monthly donations, are local charities that do like food and emergency housing and stuff for like food pantries that feed the homeless, homes for like women who have been, escaping an abusive relationship or an abusive situation. So try really like overall, I'm targeting local because then you can act like it's easy. Like you can go and see, you can like make sure that the stuff is happening that they say they're raising money for. B, I always check out the financials. Like you can look up any charity, any 501c3 and look up their financials to see how much of their money actually goes to the thing that they're trying to do rather than just raising money in order to like raise more money, like host dinners and stuff to raise more money. So I want to see a really high ratio of the money being spent on the actual thing. And then I also want to target helping people who can't help themselves or just in emergency situations or in like, it's one of the reasons why I don't really like handing out like cash to people on the street, like at corners and stuff, because there are a lot of programs that are designed that are there, like that are free, that are there to help people out of those situations, whether it's food or housing or help get a job or do something that's like, I want to make sure I'm not creating dependency. I want to make sure as much as possible that I'm helping in a way that doesn't hurt. And so going local, checking out their financials and for like food, housing, and things that are, more emergency nature or for people in really dangerous situations. Those are things that I like to fund consistently. Kind of like in the Bible, it says, give to the widows and the orphans. In that time, those were the people who they couldn't take care of themselves. And so that's the idea. That's my idea. I like to try and stay away from stay away from funding the things that are just there to be tax shelters or ways for people to continue to pay for fancy dinners and get speakers and things just to continue to try and raise more money in the future. And you can check on all those things. So, all right. We've been going a little over an hour now. Appreciate you guys. I'm going to hop off here. And we'll see you guys again next week. Lots of good questions today. Hopefully we, for all of you gold holders out there, and myself included, hopefully we crack above that 5,000 mark with gold and ideally stick above it. That'd be nice. All right. See you guys next time.